Every central bank in the developed world has been running on the same assumption for the past 18 months. Inflation is coming down. The process is slow, sometimes frustratingly slow, but the direction is clear. By 2025 at the latest, inflation will be back near target. The tightening cycle will end. Rates will come down. The post-pandemic inflation episode will be over. Last week, the International Monetary Fund released its July 2026 World Economic Outlook update, and buried in the second paragraph of the summary in the careful, measured language that international institutions use when they are telling you something important that they don't want to emphasize too loudly, was this sentence: global disinflation has stalled. Not slowed, not moderated, stalled. That sentence is more consequential than anything else in the report, because it is not a forecast adjustment. It is an admission that the process every central bank, every government, every financial market has been counting on has stopped working. That the structural condition driving inflation is not temporary. That the end of the inflation episode that everyone had been projecting is not arriving on schedule. History has seen this admission before. It has been made before in different language by different institutions in different decades. And every single time it has been made, the financial consequences for ordinary people were significantly more severe than the admission's measured language suggested. This video is the history of that admission. And what comes after it. The IMF's language requires careful unpacking because its precision is important and its implications are more alarming than its measured tone suggests. Disinflation is not deflation. Disinflation is the process of inflation declining. Prices still rising, but at a slower rate. When the IMF says disinflation has stalled, it is saying that inflation is no longer declining toward target. It is saying that the trajectory that central banks had been projecting, the gradual path back to 2%, has stopped. Inflation remains elevated, and the forces that were expected to continue driving it down have run out of momentum. This distinction matters enormously for what it implies about monetary policy and economic trajectory. Disinflation that is progressing, however slowly, gives central banks reason to hold rates steady and wait. The process is working, just taking time. Disinflation that has stalled gives central banks no such option. If inflation is not declining toward target and the forces expected to produce that decline are no longer operating, the central bank must either accept that inflation will remain above target indefinitely or take additional action, rate hikes, to force the disinflation process to resume. The IMF report's second critical admission reinforces the first. Its forecasting assumptions state explicitly that the Strait of Hormuz will not return to pre-war conditions until March 2070, 9 months from now. This means the energy supply disruption that has been one of the primary drivers of inflation in the current episode is assumed to persist for at least 3 more quarters. Energy-driven inflation is the most stubborn type because it affects the cost of producing virtually everything else in the economy: food manufacturing, transportation, heating, cooling, and therefore tends to embed itself in broader price and wage expectations more quickly than demand-driven inflation. The combination of stalled disinflation and the structural energy supply disruption that persists through early 2027 is the IMF's measured, institutional way of saying something that carries severe implications. The inflation episode that was supposed to be ending is not ending. It is becoming structural. The historical precedent that most precisely maps onto the IMF's current admission is the sequence of institutional pronouncements that preceded and accompanied the embedding of 1970s stagflation. In the early 1970s, the official position of the Federal Reserve, the US Treasury, and the international institutions, the IMF, the World Bank, the OECD, was that the inflation of the late 1960s and early 1970s was temporary. It was driven by specific identifiable factors: the fiscal expansion of the Vietnam War era, the first signs of the commodity cycle turning, the Nixon administration's wage and price controls of 1971, and their subsequent removal. Each factor had a beginning and an expected end. Inflation, the official position maintained, would moderate as these specific factors resolved. The Arab oil embargo of October 1973 was the event that made this position untenable. Oil prices quadrupled in a matter of weeks. The supply shock was external, politically driven, and not amenable to any monetary policy response. The inflation that had been declared temporary was now being fed by a structural energy supply disruption that central banks could not address with the tools available to them. But the institutional admissions that this episode was structural rather than temporary did not arrive quickly or cleanly. The Federal Reserve's public communications in late 2016 communistic emphasized the expectation that inflation would moderate, that the oil shock was a one-time price level adjustment rather than a permanent change in the inflation trajectory. The IMF's 1974 World Economic Outlook acknowledged the severity of the oil shock but maintained projections of a return to pre-shock economic conditions within 2 to 3 years. Those projections were wrong by years. The structural embedding of inflation expectations, the process by which workers began demanding higher wages to compensate for expected future inflation, and businesses began raising prices in anticipation of higher costs, had already begun before the institutional admissions arrived. By the time the IMF and the Fed acknowledged that the inflation episode was structural rather than temporary, the wage-price dynamics that made it self-sustaining were already in motion. The consequence was a decade of inflation that the official projections of 1973 to 1974 had not anticipated, and the wealth destruction that followed the negative real returns on bonds and savings, the erosion of purchasing power, the transfer of wealth from savers to asset owners, documented in the 4th and 8th videos of this series, was the direct result of the gap between what institutions were projecting and what was actually happening. The 1973's admission that inflation had a structural component, however delayed and hedged, did not produce the policy response that would have broken the inflationary dynamic. The Burns Fed raised rates but insufficiently and with too many pauses. The Nixon and Ford administrations applied wage and price controls that reduced headline inflation temporarily while allowing the underlying pressures to build. The Carter administration's energy policies attempted to address the supply-side component without fully acknowledging the monetary accommodation that was feeding demand-side inflation simultaneously. The result was a second, more severe episode of structural inflation admission in 1979. The IMF's October 1979 World Economic Outlook, released in the same month that Paul Volcker implemented his Saturday Night Massacre of interest rate increases, was, in retrospect, the clearest institutional acknowledgement that the inflation of the 1970s had become genuinely entrenched. The 1979 WEO acknowledged that inflation expectations had become self-fulfilling, that the disinflation assumed in previous forecasts had not materialized, and that the structural adjustment required to restore price stability would be more severe and more prolonged than previously projected. This was the second admission 6 years after the first. 6 years during which the official institutional position had consistently underestimated the persistence of structural inflation, leading to policy responses that were consistently too gentle to break the dynamic they were addressing. The Volcker correction that followed the brutal interest rate increases to 20%. The deliberate creation of a severe recession was the price of the gap between the first admission in 1973 and the second admission in 1979. If the first admission had been followed by the policy response that the structural reality demanded, the second admission and the severe correction it eventually required might not have been necessary. This is the historical lesson that the IMF's July 2026 admission carries. Note that the current situation will necessarily follow the same path through its worst historical expression, but that institutional admissions of structural inflation have historically arrived late, been followed by insufficient policy responses, and required a second, more severe admission before the policy correction adequate to address the structural reality was finally implemented. The pattern of late institutional admission of international bodies acknowledging structural inflation long after the structural embedding has begun is not accidental. It reflects specific and consistent incentive structures that have operated in every major inflation episode in modern history. The first incentive is forecast credibility. International institutions, the IMF, the World Bank, the OECD, issue regular economic forecasts that become public benchmark. Revising those forecasts downward is a credibility cost. The more optimistic the previous forecast, the larger the revision required and the larger the implied admission that the institution's previous analysis was wrong. This creates institutional pressure to make revisions incrementally rather than decisively to move the forecast in the direction of reality gradually, rather than acknowledging the full extent of the miss in a single update. The second incentive is political sensitivity. International institutions operate within a political environment in which their member governments, the United States, the European Union, Japan, the major emerging economies, have strong preferences about what the institutions say. A blunt institutional acknowledgement that inflation is becoming structural implies a blunt policy prescription, more tightening for longer with more economic pain. Member governments that are facing elections, that are managing fragile banking systems, or that are carrying heavy debt loads all have strong incentives to discourage such acknowledgements from the institutions they fund and govern. The third incentive is analytical uncertainty. Distinguishing between temporary and structural inflation in real time is genuinely difficult. The models that institutions use to project inflation are calibrated on historical data that may not capture the current structural change. The supply-side factors driving current inflation, the Hormuz disruption, the broader energy transition, the AI-driven productivity dynamics are genuinely novel in some of their dimensions. Institutional humility about the limits of model-based forecasting produces cautious language that understates the structural confidence that a more historical approach would suggest. These three incentives combined, credibility preservation, political sensitivity, and analytical uncertainty consistently produce the same outcome: institutional admissions that are late, hedged, and insufficient to fully inform the policy responses that the structural reality requires. The IMF's July 2026 admission that global disinflation has stalled is a significant step forward from the more optimistic language of previous updates. It is almost certainly still behind the structural reality that is embedding itself in economic behavior across the developed world. The single most consequential analytical element of the IMF's July 2026 update is not its headline growth forecast or its inflation acknowledgement. It is the assumption buried in its methodology section that the Strait of Hormuz will normalize to pre-war conditions by March 2027. This assumption deserves scrutiny that it has not received in financial media coverage of the report. The IMF's March 2027 normalization assumption is not based on a specific diplomatic or military analysis. It is a standard IMF methodology. In the absence of a specific basis for projecting ongoing conflict, assume a gradual return to pre-conflict conditions on a reasonable forward timeline. This is not an analytical prediction, it is a modeling convenience. The actual situation in the Strait of Hormuz, as documented in this series from the third video onward, does not obviously support a March 2027 normalization baseline. The US-Iran MOU of June 23 lasted approximately 6 days before clashes resumed. The 60-day negotiating window that the MOU established has produced no publicly reported progress on the nuclear questions that are the core of the structural conflict. The military capabilities on both sides, Iranian drone and missile capability, American naval and air power, remain intact and deployed. The structural incentives that drove Iran to challenge the Hormuz arrangement in the first place have not changed. A March 2027 normalization requires one of the following: a comprehensive nuclear agreement that addresses the structural Iranian-American conflict, a decisive military outcome that removes Iran's ability to threaten the Strait, or a political change in Iran that alters its strategic calculus. None of these outcomes appears imminent in any publicly available analysis. What this means for the IMF's broader analysis is significant. If the March 2027 normalization assumption is wrong, if the Hormuz disruption persists beyond March 2027, or if it escalates rather than resolves, the IMF's economic projections for 2026 and 2027 are materially too optimistic. The stalled disinflation that the report acknowledges would become embedded disinflation, with consequences for monetary policy, growth, and the fiscal positions of energy importing economies that the report's measured language does not fully capture. The March 2027 assumption is the load-bearing beam of the IMF's optimistic scenario. If it fails, as this series' historical analysis of ceasefire durability suggests is the more likely outcome, the structural inflation admission of July 2026 will need a sequel. The single most consequential analytical element of the IMF's July 2026 update is not its headline growth forecast or its inflation acknowledgement. It is the assumption buried in its methodology section that the Strait of Hormuz will normalize to pre-war conditions by March 2027. This assumption deserves scrutiny that it has not received in financial media coverage of the report. The IMF's March 2027 normalization assumption is not based on a specific diplomatic or military analysis. It is a standard IMF methodology. In the absence of a specific basis for projecting ongoing conflict, assume a gradual return to pre-conflict conditions on a reasonable forward timeline. This is not an analytical prediction, it is a modeling convenience. The actual situation in the Strait of Hormuz, as documented in this series from the third video onward, does not obviously support a March 2027 normalization baseline. The US-Iran MOU of June 23 lasted approximately 6 days before clashes resumed. The 60-day negotiating window that the MOU established has produced no publicly reported progress on the nuclear questions that are the core of the structural conflict. The military capabilities on both sides, Iranian drone and missile capability, American naval and air power, remain intact and deployed. The structural incentives that drove Iran to challenge the Hormuz arrangement in the first place have not changed. A March 2027 normalization requires one of the following: a comprehensive nuclear agreement that addresses the structural Iranian-American conflict, a decisive military outcome that removes Iran's ability to threaten the Strait, or a political change in Iran that alters its strategic calculus. None of these outcomes appears imminent in any publicly available analysis. What this means for the IMF's broader analysis is significant. If the March 2027 normalization assumption is wrong, if the Hormuz disruption persists beyond March 2027, or if it escalates rather than resolves, the IMF's economic projections for 2026 and 2027 are materially too optimistic. The stalled disinflation that the report acknowledges would become embedded disinflation, with consequences for monetary policy, growth, and the fiscal positions of energy importing economies that the report's measured language does not fully capture. The March 2027 assumption is the load-bearing beam of the IMF's optimistic scenario. If it fails, as this series' historical analysis of ceasefire durability suggests is the more likely outcome, the structural inflation admission of July 2026 will need a sequel. The IMF's global admission has differentiated implications across the major economies, and understanding those differentiations is important for reading the full consequences of the structural inflation acknowledgement. For the United States, stalled disinflation arrives in the context documented across the previous 16 videos of this series: a debt load exceeding $36 trillion, interest payments above $1 trillion annually, a new Fed chair navigating between inflation and recession risk, and a bond market that has been signaling structural stress since the first video of this series. Stalled disinflation in this context means the Fed cannot cut rates to relieve the economic slowdown that the previous tightening has produced, while simultaneously the fiscal cost of that tightening is compounding a deficit that is already structurally unsustainable for Japan. Stalled disinflation arrives against the backdrop documented in the first video: record bond yields on 30-year government bonds, a central bank trying to normalize policy after decades of extraordinary accommodation, and a debt-to-GDP ratio that makes rising rates existentially consequential for the government's fiscal position. Japan's stalled disinflation is driven partly by imported energy inflation and partly by the domestic wage dynamics that have been building through the Kishida and Ishiba administration's reflation policies, a combination that the Bank of Japan has even less room to address aggressively than the Fed. For Europe, stalled disinflation arrives in an economy that has absorbed the energy shock of the Hormuz conflict through higher import costs, while simultaneously managing the fiscal demands of the NATO burden shifting documented in the 13th video. The European Central Bank's options are constrained by the divergent fiscal positions of its member states, the German fiscal hawks pulling toward tightening, while the Italian and French fiscal needs pull toward accommodation. For emerging markets, the IMF reports phrase about the outlook being uneven, with the war shock weighing on energy importers and AI-driven demand lifting technology supply chain countries, describes a fragmentation that is itself historically significant. Stalled global disinflation that affects energy importers and technology exporters differently is exactly the kind of differentiated pressure that historically produces the currency crisis, sovereign debt stress, and capital flow reversals that compound a primary inflation shock into a broader financial stability event. The IMF's structural inflation admission, however hedged and however late, carries specific implications for wealth preservation that the historical record makes clear. The first implication is duration. Structural inflation episodes, as documented in the 1970s comparison, persists significantly longer than the consensus projects at any given point during them. The IMF's current projections assume a return toward target by 2027 or 2028. The 1970s precedent suggests that once institutional admissions acknowledge structural inflation, the actual return to target has typically taken significantly longer than the admission era projection suggested. Planning for a shorter inflation episode than history suggests is the most consistent error that ordinary savers and investors make in structural inflation environments. The second implication is that the assets that protect purchasing power in structural inflation are the same ones documented in the 8th and 15th videos of this series: energy assets, gold, real assets with pricing power, and geographically diversified positions that include economies less exposed to energy import costs. The IMF's acknowledgement of stalled disinflation is the institutional confirmation of the structural inflation thesis that this series has been building for 17 videos. The third implication concerns bonds specifically. The IMF's acknowledgement that disinflation has stalled is for the bond market a signal that the rate cut cycle that bond prices have been partially anticipating is further away than previously priced. The March 2027 Hormuz normalization assumption that underpins even the IMF's relatively optimistic scenario means that the energy inflation feeding through to CPI will persist well into 2027. Bonds that price a significant probability of rate cuts in 2026 or early 2027 are priced on assumptions that the IMF's own analysis now challenges. The fourth implication is for fiscal sustainability. Every government carrying elevated debt loads, and as this series has documented, the US, Japan, and most European governments qualify, faces a significantly more difficult fiscal trajectory in a world where central banks cannot cut rates because disinflation has stalled. The interest rate path that makes debt service manageable requires an inflation path that the IMF has just acknowledged is not progressing as projected. The fiscal consequences of this misalignment are not immediate, they accumulate gradually, but they are structurally significant additions to the debt dynamics this series documented in its first video. Global disinflation has stalled. Four words: institutional language. Carefully hedged. Released in a report whose headline gross numbers provided the reassurance that financial media chose to emphasize. But those four words read through the lens of monetary history, through the 1973 and 1979 structural inflation admissions that preceded the most consequential wealth destruction episodes in post-war American economic history, carry a weight that the IMF's measured language deliberately does not emphasize. This series has spent 17 videos documenting the mechanisms of the current transition: the bond market stress, the gold accumulation, the petrodollar vulnerability, the middle-class wealth destruction, the dollar sanctions weapon, the internal political fragmentation, the reserve currency timeline, the asset class survival record, the ceasefire fragility, the Fed share transition, the Chinese treasury sales, the alliance burden shifting, the convergence day dynamics, the stagflation pattern, the institutional bypass represented by Visa's stablecoin platform. Each video added a mechanism. Each mechanism pointed in the same direction. The IMF has now added its voice to that direction, not loudly, not with the urgency that the historical pattern suggests is warranted. but clearly enough for anyone reading carefully to understand what the institution is actually saying. Disinflation has stalled. The process everyone was counting on has stopped, and history knows what comes next when that happens. Subscribe, because this channel reads what institutions say between the lines and what history says comes after.